Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today we are talking about a new position in the portfolio, and it's going to seem controversial compared to what I've been talking about over the last 2 to 3 years. But I've actually taken a position in US Treasury bills, very short term, key distinction, short term. So we're going to talk about that. If you're new to the channel, welcome. Please do like and subscribe if you like the video. It helps the algorithm a lot. And we have a lot to talk about. So today, talking about the Crassus Investment portfolio that is available publicly on eToro. You can download the app and you can follow along, or you can actually invest by copying the portfolio should you have funds at your disposal. And as always, we're going to talk about the ROI Club, which is a publication that I have where members get access to premium level content. We're going to talk about buying treasury bills. Why am I buying treasury bills when I've been so bearish on bonds? And getting paid to wait plus upside potential as a concept in general, and how it applies to this particular idea in positioning. Disclaimer, of course, none of this is advice, financial advice. It's just purely to document what I am doing with my particular capital. I am not qualified to give financial advice, so I don't. This is just my opinions, what I'm doing, and you need to seek your own professional guidance. So let's get into it. If you're not already a member of the ROI Club, you can join the regular publication for an astute private club of investors. It's on Substack, so you'll know the deal with Substack. You get a 7-day free trial without having to pay anything, and you get access to macro analysis, scoreboards, intelligence nodes that I have, and every month at least, I do an update on the economy, and I also do, very specifically, an in-depth overview on a particular company that I am looking at. And so I give you my valuation sheet for that company. You also get to be part of a community. So you can try it for a month. It's like $9, or if you just pay annually, it works out to be $5 a month, and there's a free trial. So that's that. That's the hard sell out of the way. So why am I buying bonds? So the landscape is very different now than where it was even 6 months ago, and certainly 12 to 24 months before that. Now, I've spoken a lot about how I don't like bonds because it has a negative real yield, meaning the nominal yields at the long end of the curve are less than the inflation rate. Okay, so over the long term, you're losing money. Very, very key distinction. Technically, I'm not buying a bond, I'm buying a bill. Why is that? Because anything less than 12 months is a bill, then you go into 1 to 10 years as a bond, and then you go to a note after that. Okay, it doesn't really matter. It's a fixed income instrument. That's a debt instrument. In this case, I'm buying US government debt that's issued by the United States. So in the short term is where I'm focused. So what these are debt instruments issued that have a payout over 1 to 3 months, or 0 to 3 months, I should say. Okay, so you're giving money to the government, they're paying you a yield, and then they give you your coupon or your capital back. So you give $100 to the government, they give you a yield, and then at 3 months, you get that $100 back. So it's very short term. You do not have the risk associated with the long end of the yield. Whereas if you lend the government money for 30 years, 20 years, 10 years, whatever, depending on the government, depending on the bond, you would get paid out over that time. But that yield is terrible, and it has a hell of a lot of risk associated with it, in my opinion. So very important to separate those two ideas. So why is that? Well, I want to barbell the portfolio a little bit. At the moment, I'm looking around. There's not anything that's really taking my fancy other than a few energy producers with ridiculously high free cash flow yields, particularly in Latin America and emerging markets. Then you've got that. Then on the other side of the table, we've got energy exposure already. And so this is sort of the aggressive cash generating plays. I like offshore oil services a lot, and that's already run on me. We're up over 100% on the position in Transocean. And so where's the value? I'm not really seeing anything particularly that's jumping out at me yet. And so I'm holding cash. The question is, what do I do with that cash? And I would like to be paid for the opportunity to wait. And for the first time in a long time, we actually have that opportunity available to us. And that is via these notes. So instead of holding cash that yields me, I don't know, maybe 1%, 2%, depending on your broker, depending on your account, I say to myself, well, the Fed's raising their rates. Why don't I put these in very short-term bills? I'll get paid a yield of about 4.57% at the moment to essentially wait. And that gives me a lot of optionality. You can wait and see what happens in the markets. And if we see some bargains, it's the most liquid market in the world. We can take that cash out and we can deploy it while we're being paid to wait. And there's another interesting thing, which is the chance of a capital gain. And it's a decent chance. Why? Because we're getting closer to the Fed reaching their terminal Fed funds rate. Okay. As you'll see in a moment in the chart, Fed funds rate and the T-bills, basically, they're the same. Okay. And that makes sense because it's the rate at which the US government borrows. Okay. So they're going to track in lockstep. There's a good chance that the Fed will have to stop and potentially pivot or retrace their course. When that happens, the yield on these bonds will drop, and the relationship between price and yield is what? It's inversed. So the way that yield will drop is a capital inflow buying up the bonds, driving the prices up, and that is why the yield will drop. So in that case, we would receive a capital gain for that. Okay, think of a rental property. It's yielding you 10%. 10 grand a year, 100 grand house. Someone comes along and pays you 200 grand for that house. The yield has halved, all else being equal, right? So that's how that works in a very extrapolated example. Another thing to be aware is that the market really, you look at the PE ratio at the moment, the earnings yield is terrible in the broad market. If you're getting paid 4.57% yield to stay in safety in the highly liquid market, a market scare would sell off out of stocks and people would start to flock into bonds. That's just the way that institutional investors work. It's where their algorithms work. Whether it's good or not is another question. But that would lead to that effect. That capital inflow would drive up the price of the bonds. I would make a capital gain. I would look at what's around, probably sell the bond and deploy that capital elsewhere. So it's got a barbell hedge to it. It's a way that we can gain some yield rather than just sitting on idle cash. So let's take a look at the charts. 5-year chart for the yield we're looking at on the government bonds. So here today it's just ticked up 4.7%. So that's quite nice. 4.7% is not a bad yield to be at the short end. I would not accept that as a long-term yield over 30 years because inflation, I believe, will be higher than 4.7% yield on average. Okay. Difficult to chart this. So what I had to do was use the bars, okay, to kind of give you an idea. This is the Bloomberg index. It's an ETF that tracks the yield. And this is the way that you have to invest in eToro. You can't necessarily buy the straight bonds, okay? So this is looking at the price as opposed to the yield. So it's the inverse. So at times where you see here, for instance, during COVID, where the Fed basically monetized the US government by buying its own bonds, okay, to artificially lower interest rates and help create more reserves to goose the liquidity in the markets, the yield drops, and inversely, the price spikes. Then since we've been on this rate hike, we've seen that start to come down, and then we see things start to come back up in the price because people are all of a sudden getting paid a decent yield, and the opportunity cost becomes higher. Okay, here we have the yield tracked out in this bar using as a percentage growth over the 5 years. So 4.7% might not sound like a lot, but compared to where we were, we've grown a lot on a percentage on a relative term. And this is what I was talking about. So the Fed funds rate here in the purple line, as you can see, it's basically tracking in lockstep with that 0 to 3 month yield. Why? Because that's the rate at which the US government borrows from the Fed, and you're going to have a very small spread as a government then when you issue those bonds. Okay, so we get money from the Fed, and then they put out bonds, and you're buying short and selling long, essentially. In that case, it's a banking model. So you're trying to get debt at 1% and then sell it out to investors at 2% as an example. So what is this I'm talking about? Expecting a capital gain, expecting the Fed to retrace course. So here you can clearly see a downward tendency. We're seeing lower peaks over the last, I think it's about 30 years or so. And where we are in terms of the US being so indebted, there really is a ceiling at which those interest rates can rise. And so the question becomes, where is that ceiling? I've spoken before about a lot of Luke Gromen's work and others that suggest anywhere into that 5, maybe 5.75% range as a Fed funds rate would be really pushing it, given the level of debt that the US has. So we're getting close to that. And my idea is, well, we'll get paid the yield while we wait for the Fed to reverse course, let's say, or at least pause, in which case interest rates might come, they may need to lower interest rates to help the economy or to help the US service their debts more likely. And as such, that lowering would represent a capital gain for us. Okay, so we've got a few options. So there you go. That's the reason why it seems like it's counterintuitive, but it's really in the sense of the same thesis. And so that is that. I hopefully you enjoyed it. If you like the video, please do like and subscribe. And if you're interested in following or copying the portfolio, link in the description. And I hope to see you on the other side. Until then, take care.